So Jerome Powell strikes again, hitting the markets with a 25 basis point rate hike to maintain his credibility, well, kind of, and offers up some clarity as to how the Fed will proceed into the remainder of 2023. Now, obviously, we sold off quite aggressively into the close here, but there's really just one dynamic that you need to focus on if the markets are going to see continuation in the downward direction for the remainder of the week. We're going to explore that concept and more in today's episode of the Midweek Market Update. Hit the thumbs up button and subscribe to the channel if you've not done so already. Check out the links listed down below and stay tuned until the very end of the video. I've got 3 additional trade ideas to share with you that you're not going to want to miss. With that said, let's kick things off here on the SPY daily time frame chart. What do we see from a trend perspective? Still definitely in a daily downtrend with lower highs being found at a structurally significant area on today's session. 401 is the number. Should make sense from prior resistance turning to support after the break, retest, and rally. And in more recent time frames, if we do something like this, we'll recall that it was just the top of the balance from in here and really kicked off the leg lower from the banking crisis. So 401 makes sense from a structural perspective. If you were to have drawn in a resistance trend line, you get confluence of resistance right around this area. It's also the upper edge of the weekly expected move and the daily 50 SMA, the blue moving average on your screen. It's not to say that anybody nailed the top. I mean, maybe you did because we are in an overall daily downtrend. We're coming off of a lower low, but bulls should certainly not have been pushing their luck at the upper bound of the weekly expected move here, coming into structural resistance. With that said, though, we know that on the hourly chart, there was some reason to be slightly optimistic about higher lows being produced, higher highs, the gap and go from Tuesday's session. That optimism has been kind of wiped away, if you will, on today's close, being back down underneath 390, 350, right? So structurally, it represents the bottom end of this balance in here, the top of this balance in here. It also would have represented a gap fill reversal, of which we had absolutely none on today's session. So no gap fill reversal, closed firmly underneath 390, 350. We've also closed underneath our daily 200 SMA, the green moving average on your screen. If we take out the Fibonacci's from the low of the move here to the top of the move up here, we're back down underneath our 61.8, putting us back down in the bearish consolidation zone. And if we take out our anchored VWAPs from the October low, and do something like this, notice that this is the pink one and we're sitting right on it. So the lower bound of the VWAP band, if you will. At first, it was looking quite optimistic. If I zoom in here, notice that early on in the session, as and before Jerome Powell jumped on the mic, we were actually above the entirety of the band. And as of the close, we've moved through the entirety of the band and are sitting right on the lower edge of the October VWAP. So all things considered, bearish sort of pressure was applied here, and there's less optimism about a trend reversal on the daily time frame with a close back down underneath 390, 350. With that said, let's move on down to an hourly time frame chart, and I want to walk you through how this plays out into the remainder of the week, or what I think is most likely. So obviously, with the bearish pressure, we have ourselves a range here. This was a look above and fail. Technically, the target is always the bottom end of the range, and that doesn't change this time around. So 384.75 is still the target on this time, the look above and failure back down into the range. So a couple of ways that can be accomplished. Number one is that the bears just see straight up continuation, which is momentum in the downward direction, breaks right through 389, brings us into 384.75. That's the most bearish case that could possibly unfold, just straight up blasting lower through all of these structural areas. Now, I don't necessarily think that's the case. We'll talk about why in just a moment on the internals, but the bears can also accomplish continuation in the lower direction with an hourly lower high up against 396.50. Why 396.50? What was once prior support turned into resistance, was support on the Tuesday lows, and also a little bit of support here as Jerome Powell initially started speaking, right? Obviously, the momentum took us underneath that on today's session. So bears, you just got to keep price underneath 396.50, and bears are in control of this market. You can certainly start to see how this produces a hourly head and shoulders pattern. Now, the concern is, for the bears that is, the concern is as we just described on the daily very briefly, this is still technically an hourly uptrend. We have an hourly channel in the upward direction. We're sitting right on the support trend line. So if we do just get a sharp recapture, it's got to be the lower high and breakdown. If we move above 396.50, here's what it must be for the bulls. There's no ifs, ands, or buts about this one because of the daily lower high that's in place. The bulls need a higher low above 396.50 if the market is going to be more constructive back in the upward direction. So really, tomorrow, if you're only going to have one level on your chart, it would probably be 396.50. Lower highs keep the bears in control, and over time, we're looking for 384.75. And if the bulls are brave enough to push it back above with a higher low confirming the recapture, then maybe we can start to change our tone back in the upward direction. But obviously, as of right now, there's some pretty clear momentum in the downward direction. For tomorrow's session, we'll talk about this in the internals in just a second. I would personally be watching for this as a primary outcome. And again, this over time, 384.75 over time, but probably a lower high underneath 396.50 first, not just straight up continuation. Let's talk about why now on the internals. So the top right-hand corner of the screen's got you covered with a brief tutorial if you're not familiar with this screen, but overall, let's note that today it was bearish, but really only into the close on the momentum from Jerome Powell's speech. So if we think about what happened on the Monday and Tuesday session, technically there were bullish inflows. And on today's session, the cumulative read for the week, which by the way, the script is available on our website now, it's really just back down to flat. It's at the neutral mark. It's like we're starting from scratch here. So the net flows on the week strike me as being balanced. In terms of the advanced decline line, there was some pretty positive indications here, especially on the Tuesday session. The gap and go did hold the advanced decline line in this upper bound. On today's session, it was fairly neutral, getting tangled up around the zero line, not stuck down below in trend lower zone. Don't get me wrong, it did deteriorate very rapidly into the close. This did deteriorate very rapidly into the close, but overall on the week, there hasn't really been much bearish momentum, and that kind of speaks for itself with the gap and go from the Tuesday session. On the cumulative builds in the tick, notice how compressed they are. Really no momentum throughout the course of the day. This is kind of reasonable considering that the market was holding its breath ahead of the FOMC announcement. So it really boils down to, do we see continuation? Do we see bearish continuation in the internal specifically on tomorrow's session to cement the idea that yes, bears are in control? I don't really think the bears have the opportunity here to let internals go neutral. If they go neutral or even slightly bullish in the volume flows, if the advanced decline line climbs tomorrow, and if the ticks are mostly positive, maybe we get a build that maybe makes it up to like 3K. That's going to be an indication that, hey, the bears kind of had their shot at it from the Jerome Powell momentum. They didn't capitalize on that momentum. The risk is obviously to the upside for that bullish indication, the recapture of 396.50 that we just described on the SPY. So it's got to continue to be applied. Bearish momentum needs to continue to be applied if we see that complete look above and fail. Market profile is always Exhibit B, and there's a video tutorial for you in the top right-hand corner if you're unfamiliar with this screen. Overall, we're going to keep it very simple here. Value was actually overlapping to up on today's session from the Tuesday gap and go. This is even if you turn on the extended 415 session. The point of control also moved definitively higher on today's session. Don't get me wrong, this is because the speed of the tape was so aggressive through that breakdown, but value technically moved higher on today's session. Once again, another reason as to why the market may not just want to see straight up continuation for tomorrow's session. We want to see that lower high and then continuation after we maybe tag or resist the bottom end of the value area overhead. Now, we also have spike rules in place for tomorrow's session. You can see M period here produces a spike. So let's briefly go over the spike rules. If we open in the spike, we're accepting these lower prices. You should look for value area to be built out in this general zone. If we accept above the spike, if we open above the spike, I should say, this is all about the open. If we open above the spike, that's a rejection of these lower prices. You better believe we're going to see a short squeeze back up towards the highs of today's session, back up to the top edge of the weekly expected move. And if we open underneath the lower edge of the spike, prices should auction lower until we find new buyers. That's where I start to imagine on the SPY daily chart, maybe we head towards 389. Moving back on over to Thinkorswim to evaluate the weekly performance of our sectors, which by the way, this script is now available on the website. Notice that the XLE is leading the pack here, up 3.39%. Not ideal from a posturing perspective, but just underneath it is the XLY, XLC, up about 1.03 and 1% respectively. That does strike me as a healthy indication for the market. And at the bottom of the barrel, we see real estate, utilities, and staples. All three of those are lightweight risk off sectors. The fact that they're lagging this market move does strike me as posturing that's more bullish than bearish, right? So the one thing I was mentioning in the intro that you need to be focused on is what happens with the risk on sectors at key support. So if we're looking at support, we need to be looking at structure. Let's dive through these charts and see what's going on. Energy, it's a lightweight risk off sector. Overall, it's trying to stay above this little balance from in here. As long as it's chopping around in here, fine, neutral for the market. It starts to become a concern from a leadership perspective if we get a higher low above 82.65. So as is, not really a big deal for the remainder of the week. XLY is where things start to become much more interesting. This is definitely a heavier weight risk on sector. We know that this is a very important range. We've moved from the low basically to the top, not all the way, but basically to the top. And now we're just experiencing a bit of a pullback. Where have we pulled back to? 141.75. What's structurally important about that? Prior resistance, 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 gap and go above it, support from in here, rejections underneath, and now we're above. So could this offer up some support at the midpoint of the range? Absolutely. And if we think about pattern, right, if this is an inverted head and shoulders Of course, it's going to be very difficult for the SPY to actually break down in a significant manner if the XLY remains above 141.75. Now, let's not get this confused. The pattern and location would strike me as being optimistic from a structural perspective, finding a daily higher low. Lows, higher lows. Nothing about this candlestick is overly bullish. As a matter of fact, it's quite bearish, right? We have an upper wick that breaks the prior high and we've closed underneath the prior low. It's not technically a bearish engulfer, but you get the idea. There's a fake break and the sellers run away with it into the close. So I would say it's pretty important to wait and see what that reaction is around 141.75 early in the session on tomorrow. If we get a bounce off of it, you know that the market's probably not going to break down. If we start trading underneath, okay, a heavier weight risk on sector has given up key support. Maybe it's time to look for more of that downward flush. The same thing can be said about the XLC, right? And we're talking about big time structure here. Once again, the implications of the daily bar, definitely bearish, but the structure underneath us could offer up a daily higher low off of 54.30 still. And once again, you can start to see this as an inverted head and shoulders pattern. Even if you don't want to call it an inverted head and shoulders, just think about the trend here. We have a big low, it was a lower low, and now all of a sudden we've taken out this high, we've taken out this high, we've produced a higher high above not only the double bottom neckline, you could say, hey, double bottom here. We've also taken out this high. So it's very reasonable that a higher low pullback could be formed and the trend actually flips in the upward direction. So this is the optimistic take for the market and why I don't necessarily think that markets will just continue to flush in the downward direction. I could be wrong if all of this support breaks, but structurally speaking, this is what I'm concerned about in these heavier weight risk on sectors. Next up is the XLB materials, really lightweight sector. This has almost no bearing on what the S&P is going to do tomorrow per se. Overall, we've got a break, retest, and now lower. So this does strike me as a bearish implication for the S&P, but again, really lightweight sector. So moving along, XLF, obviously another big threat in the downward direction. This is certainly producing a bear flag in here, and a threat of 31 brings us lower. Now, as I've pointed out in the past, I'd be very mindful of a fake break underneath 31 that then comes back above, sweeps the lows, traps a bunch of new shorts, and then rips back in the upward direction. Structurally, this is bearish, but obviously there's the case to be made for a big lower high, like anywhere underneath 33.15, even anywhere underneath way up here, like 35.20, right? So bearish from a structural perspective, but I would just, again, new money shorts down on the lows. We've kind of consolidated sideways enough, long enough now where it might be worth taking a go at it. But as I've been a proponent for in the past couple of videos, if you're going to short IWM, XLF, any banking stock at the low, size your position for zero with puts and manage your risk that way. I would not really trust a stop loss down here, okay? So 31 is the level to watch. If it just stays sideways in the range and we find support XLY, XLC, fantastic. You're probably not going to get an S&P that breaks down. Now, if this breaks down, if we're not holding higher lows, XLC, XLY, of course, S&P should move lower. Next up, XLK. This is another one where from a daily trend perspective, we've just made a brand new higher high. We've closed this overhead gap. We've got ourselves an inverted hammer. Is it reasonable that a pullback unfolds here? Yes. But is the market poised to go to zero in the XLK tech sector, the heaviest weighted sector of the S&P 500? Absolutely not, right? Even if we get a pullback, you can offer up a higher low at 139.25. If that's subject to change, if we start getting price acceptance underneath, we'll change our tone. But as long as we're above that level, I think it's reasonable to say, okay, here was a prior range. We got some tangled up around there, right? So if we retrace the entirety of the breakout, we still could find a daily higher low here, right? So that is the bull. Again, I keep saying it over and over again, but that's the optimistic take on the market. If you're a bear, you just want to see the pullback, bring the market to hell in a handbasket, move right through that support, no hold, nothing. XLV, chopping through this range. We know that we're at the bottom of the monthly balance area. I would just be kind of neutral XLV. It definitely has more of a bearish tone here. There's no arguing with that one. XLV is definitely more bearish here. Being the second heaviest weighted sector for the S&P 500, probably noteworthy down here at the lows. Next up, if we take a look at the XLI industrials, about 8% of the S&P sitting right on the balance lows once again after a look below and failure back into the range. So I would expect downside this time around. Buyers had their chance to keep things elevated, obviously didn't unfold that way. So expecting bearish pressure out of the XLI. Real estate, what's going on here? Breaking down big time underneath the bottom of 36. Prior support, new lows were made. This is bearish drag. Whenever you're making a new pivot low in the lightweight sectors, that's where it really becomes much more important. So this does strike me as noteworthy for the downside. Utilities, this did not make a new pivot low. So again, kind of neutral in this box in here. It's a lightweight risk off sector. So if it just wants to go sideways and the remainder of the market actually does catch the higher low in any of the big three that we've kind of just described, I wouldn't be concerned with utilities, even if it does poke down underneath. Now, if everything's moving in unison to the downside, that's a different story, and we should look out below. Last but not least, XLP, consumer staples. This is D for defensive. It is more risk off, and it's stuck sideways really in this nasty-ish type range. I mean, this was acting as a previous level, but we've just chopped through it the past 3 trading days around 72.50. Very difficult to say what the direction is out of this one. Technically speaking, if the market's fearing a recession, you should probably start to see some outperformance out of XLP staples from a recessionary perspective, right? You get inverted head and shoulders, maybe it breaks, but it just hasn't done so on today's session. Moving lower with almost everything else doesn't really strike me as the clearest indication for markets. To me, it's really just neutral at this current stage. The sector ratios are a great way to visualize relative strength and weakness, so check out the video in the top right-hand corner if you don't know how to set this one up. I've got you covered with a tutorial. Let's take a look at the top 4 heavyweight risk-on sectors. Notice that the XLK continues to be an outperformer, actually upticking on today's session. Healthcare was one of the only other sectors that ticked higher, as did consumer staples down here. Everything else actually saw a downtick on today's session. So overall, risk on remains mostly in force, barring the bad apple here in the financial sector, which we know has been the case for quite some time with the whole banking crisis going on. That shouldn't strike anybody as a surprise at this point in time. Healthcare is trying to find a base down here. Recall that because it's the second heaviest weighted sector, we need it to participate in upside rallies, and the XLY is holding on. It's maintaining a little bit of a grind above its upward sloping daily 50 SMA. That's the yellow line on all of these charts. The bottom 4 are the risk off sectors. Notice that again, barring the XLP, everything continued to tick lower. We're back down underneath a descending 50 SMA here. We're underneath a descending 50 SMA in energy. Real estate fell off of a cliff, and consumer staples, although it did uptick on today's session, it's not dramatically outperforming. It's not doing something like this where we would say, oh, this is significant. There's a huge flight to safety taking place from a sector rotation perspective. Let's take a look at the XLY over the XLP. So we've got ourselves growth versus value. And just like there's no clear flight to safety trade taking place in the XLP isolated, there's also not one in this particular ratio either. You'll notice that we're just chopping around an upward sloping 50 SMA. We're still above these pivot lows from back here. So there's no big breakdown in risk off dramatically flooding back into the market. I think, we'll probably learn something about these markets as this big red bar resolves, whether or not it ticks back higher tomorrow when we actually get back above 393.50, above 396.50. Probably means that, again, we're seeing an outperformance here. That would be one of those indications, or rapid deterioration. We'll learn something when this breaks through roughly 1.9. If we break down aggressively through 1.9, yeah, risk off is definitely coming back down into the picture. But as of right now, it's hard to say anything other than it's kind of neutral, still looking for that opportunity for a big daily higher low. Having a quick glance at the dollar, we'll notice that our inverted head and shoulders is now off the table. This pattern is not really a threat back in the upward direction, as we've broken down underneath the right shoulder area around 103.50. So technically speaking, a weekly downtrend remains in place with highs, lower highs technically here, and then this kind of zone is your next weekly lower high, looking for an equal low to be produced right around that 101-ish area. That would be, of course, bullish for equities if the dollar continues to fall here. If we take a look at the gold contract and just have a look at this, I mean, we're just getting bull flag consolidation up here at the highs. This technically could continue to break in the upward direction, which would technically be bullish for equities, considering that this should, in theory, all things held equal, banking crisis aside, all things held equal, this should be putting downward pressure on the dollar. So overall, this relationship does actually strike me as positive for equities here, but we'll see. One step at a time. Obviously, the banking crisis is an issue that we have to deal with, so I'm not quite sure that the relationships are so straightforward at this point in time. If we take a look at the TNX and what's going on with interest rates, especially on a session like today, notice that the market is begging Jerome Powell in the next meeting to say, hey, we're going to pause or even cut rates, right? This is threatening a flush of 34.30 in the TNX. That's 3.43 in the 10-year rate. And if this breaks down, in theory, that would also be a positive indication for the TNX. However, a breakdown in rates is not always equal. Are rates breaking down because the Fed needs to come to the rescue, or are the rates breaking down naturally just because of the way that yields are working out? Obviously, in this instance, if the Fed has to start cutting rates, it's a sign that something is probably much worse in the economy as a whole. Something is broken. So rates breaking down here naturally might be bullish in the short term, but in the long term, I would definitely pay attention to this relationship if they start to break down, because the Fed is clearly signaling, hey, we need to step off the gas. Things are not looking so hot for the near-term future. As widely anticipated, we got the 25 basis point rate hike, but that's not the important part. The new SEP, Statement of Economic Projections, is really the kicker here. here. It's saying that there's likely one more rate hike in the chamber and then some sort of pause via the implied terminal rate for the Fed funds rate, right? It was at 5.1. So one more 25 basis point rate hike brings us to 500 to 525. And already the Fed tracker tool is pricing in about a 50-50 odds of either a pause or actually getting that one last and final rate hike. Now, Powell was very nimble in the way that he worded this by explicitly stating and calling out that they're no longer using the phrase rate hikes are appropriate to tame inflation. It's going to be changed to some additional policy firming may be appropriate. So two key takeaways. Number one, policy firming does not back them into a corner by explicitly stating rate hikes. And number two, obviously adding the term may be appropriate means that they may not even do them in the first place. So he's going to maintain his credibility by saying, hey, I'm just doing exactly what I told you we would be doing. And I called out that we're making this change right now. Speaking of inflation, Powell says that the disinflation process is still very much so underway. And they're feeling pretty optimistic about early summer, starting to see housing inflation actually start to cool off, which has been the sticky portion of inflation. Now, unemployment will likely have to go up. The labor market is still far too tight, he acknowledged. So Elizabeth Warren, don't throw a little bit of a temper tantrum. Let's please try to keep it civil there. It's part of the process. It's part of how markets work, right? Anyways, if we take a look at the CPI, this is the PCE, not CPI, you'll notice that the current is 4.7, and a very, very traditional rule of thumb metric to kill inflation is that you want to bring the Fed funds rate above the rate of inflation. And we finally achieved that. Not finally, it's been that kind of like going neck and neck up here as these rate hikes have been underway, but we're firmly above 4.7 now with 475 to 500 in the Fed funds rate. So this is a good step in the right direction as well in terms of starting to signal that, hey, the fight against inflation is working. We're kind of where we need to be by this rule of thumb. Now, don't get me started on you're experiencing high prices in your grocery store still. Anecdotal, based on the data, based on what the market actually looks at, this is kind of working so far. Another indication that the Fed funds rate is going to have to start cooling off sooner rather than later is that if we take a look at the 2-year, right, this is aggressively saying, hey, cool it off here. You're going to start breaking something, Powell, if you don't, dial it back down, aka pause, or just maybe there's one more 25 basis point rate hike. But that's what the 2-year is telling us. And if we take a look at the back end of 2023 from a probabilities perspective, this should not be a warm and fuzzy feeling. These aggressive rate cuts, it's really more of a signal that something's broken in the economy, and the Fed's going to have to rush in and save the day basically by starting to reverse what they've ultimately done here. So recall that in the original, in the beginnings of the rate hiking campaign, they were explicit about higher for longer, meaning that, hey, we're not even going to consider rate cuts until 2024. Obviously, we're already starting to price them into the back end of 23. So once again, this is more of a signal of concern as opposed to, hey, the market's going to rally and just, go to the moon because easy money policy is around the corner. It's really saying, hey, recession is kind of around the corner is what this, to me, would start to indicate. I want to draw our attention to the business cycle chart just because it's making sense from a narrative perspective. DBC is continuing to break down underneath this flush point on the weekly time frame chart, which is a disinflationary process, and Jerome Powell has mentioned that in his speech today. So number one, from a bottoming perspective in equities specifically up here, is that commodities want to top out, disinflationary process. The chart pattern matches up beautifully with what Powell has been saying. From there, we usually look at the TLT to find some sort of meaningful bottom. The pattern would suggest a breakout over these highs could start to form a new uptrend in the TLT, and this would also make sense seeing that in the back end of 2023, we're expecting aggressive rate cuts, which is of course for the fear of recession. So if this starts to outperform, flight to safety makes sense. This is always number two from the cycle perspective. So far, so good in aligning the narrative. Typically, when the Fed pivots from raising rates to cutting rates, we see more pain in the equities market. Therefore, that would imply that this has not bottomed yet. Doesn't mean that we should just short this thing into the ground on Thursday and Friday. Just saying from a narrative perspective, makes sense that we could see more pain in the future. Then once the inflationary process has resolved, that's where we start to look for the more meaningful bottoming process in equities. What does this mean for us as day traders? Probably not all that much. It just reaffirms that the cycle is kind of working as it quote unquote should, and the market is kind of fearful right now of a recession around the corner. If we take a look at the TLT and what this is suggesting, it's saying, hey, we are actually outperforming. There is already becoming some flight to safety trade taking place, but a good counter to this, and it's been a good counter for a couple of weeks now, this has kept us level-headed, right, in terms of not getting overly aggressive at the lows, is the HYG junk bonds, quote unquote smart money. Notice that it's still stuck sideways in this overall range. It's not suggesting a big breakdown of 73 as of right now. Therefore, on a relative basis, I would say that even if the market does break down, as long as this is in the range here, we're not expecting a big sweep of the lows underneath 3850 in our SPX. We could also take a look at the Bitcoin chart and see what's going on over in the digital gold. And we'll just note that strength continues to be shining here, apparently. And this is a risk-on asset, right? I've been arguing with folks in the comments section about this. Bitcoin is not a defensive asset. You might fear that, hey, the dollar's going to go kaputs and everybody's going to rush into Bitcoin. It's going to be defensive from that perspective. As of right now, absolutely not the case. Bitcoin cannot be processed, or it cannot handle processing as many transactions as the dollar, so to speak. So if you think that Bitcoin is a defensive product right now, I would just kindly disagree and say, hey, to each their own. You can think your thoughts, I will think my thoughts. And from a technical perspective, this would speak to much more risk on in the market, noting that we have made a low, and as we pointed out in the prior analysis of Bitcoin, a new higher high above this area in here. We've held up, we're back above the breakdown candle high. This speaks to risk appetite being somewhat strong in the digital gold, and of course has much more of a one-to-one correlation with the NASDAQ, but overall, it would just suggest that, hey, risk appetite's still strong. HYG is going sideways in that range there. Things are okay as of right now. We're not expecting Armageddon in the market. Having a look at our breadth indicators, notice that we have an uptick so far on this week's session for the new highs versus lows, but we're still firmly underneath the zero line, threatening to morph into a look like 2022. This does not make me feel warm and fuzzy inside from a bullish perspective. Neither does the SPX A200R stocks trading above their 200 SMA in the S&P 500. An uptick on this week's session so far, but still underneath the 50% mark. And really bearish is actually the SPX A50R stocks trading above the 50 SMA. This is a daily time frame chart instead of a weekly, so we can compare apples to apples here and here. Even as the market has rallied, notice that this has gone sideways. We have not seen any meaningful recaptures of the 50 SMA in really a majority of stocks in the S&P have not recaptured their 50 SMA on this little rally that we've seen, which of course is not all that thrilling from a bullish perspective. The most telling is the RSP, right? As we talked about in the intro, we need to watch the tech sector. We need to watch the heavyweight risk on sectors, XLK, XLY, XLC. RSP equal weight is trading at or even slightly below the December lows. The regular weighted S&P is obviously off of those lows. If the tech sector fails to continue to hold here, that would suggest we could easily go back down to the December lows. So RSP is another indication that says, hey, heavyweight risk on sectors, you've got to find those higher lows. Otherwise, we can kiss it goodbye and look for a move in the downward direction. If we take a look at the Dow transports versus industrials, they are starting to sync back up. One thing that I would just be mindful of is that this clearly can turn into a bear flag on a flush of these lows, break down to the bottom end of the range. That starts to become more in alignment with what's going on here, which is clearly not yet threatening the bottom of its particular flag. If they do start to move into sync, that would be more of a confirmation that yes, the markets are ready for a downsided move. Having a look at volatility, you'll notice that we found a hammer candle on today's session off of what was prior support, turn to resistance. We were hoping for a more tame 2023. Obviously not the case, and this would imply that, if this breaks out, it probably means the market is moving lower here. Not a warm and fuzzy feeling finding support in the VIX above 2050. If we take a look at the VVIX, which is the volatility of the volatility index, very similar things can be said. Zooming in on this range here, we found a hammer candle above prior resistance, which would speak to the odds of, hey, if this perks back up to close the overhead gap, would not be unreasonable, and it would certainly imply that the VIX itself is moving higher, likely on bad news, bad movement, bearish movement in the S&P market. Taking a look at the VIX futures, are we in a backwardation? Not quite. You can see that we have moved out of the backwardation here in the VIX futures, but 9 versus 30-day VIX is certainly above the zero mark. So money managers probably still not content overall with allocating capital in this market environment. You really want to see this come back down underneath and this move into a stronger contango, probably closer to these lows, 0.5 or underneath in the negative direction, of course. Rounding out the broad market with the QQQ, notice the nasty inverted hammer, large upper wick looked above the prior high, failed underneath the prior low. Does strike me as being bearish from a nuanced daily candle perspective, but overall the structure once again is bullish like the XLK. Not going to belabor the point, I'll just give you the numbers. Double bottom neckline still very much in play for a higher low zone in between 302.75 and 300. bears start to make more headway structurally on lower highs underneath 300, right? You can see that this was a prior range, this was a prior range. If this is look above and fail, lower highs under, right, that 300 zone become much more meaningful. If it just goes sideways up here, very difficult for the market to see an outright crash, especially as tech is the heaviest weighted component of the S&P. Next up, IWM Russell 2000 and the small caps as a risk on versus risk off gauge. This is saying stay far, far away from this market. We are right back down at the flush point. Just like the XLF, I'll continue to sound like a broken record, but I think it's reasonable. If you're going to try to short this at the lows, use an options position, size it for 0, only be willing to lose the amount of premium that you put into the trade. If that means 5 contracts for you, so be it. If it means 10 contracts for you, so be it. If it means 100 contracts for you, so be it. However you want to manage your risk, I would do so with total position size if you're getting involved shorting at the lows here around 171. It certainly does look like it could break down, and the target underneath us is the lower edge of the weekly expected move and prior structural support from back in here of September of last year. The level is 164 even. Again, just like in the financials, if we do get a nasty undercut, sweep the lows and pop back into the range, think about the trap shorts. Heck, maybe you might even be one of them who wants to close out of their position and think about the nasty short squeeze in the upward direction. It's just a risk to be mindful of. At this point in time, yes, bear flag. We've had multiple opportunities for the bulls to try to get out of this range, and they have failed every single time. Does this seem like a very likely situation? It's probably not, it's not an 80% odds that that's going to happen. It's just something to be mindful of. Overall, the pattern, yes, would suggest risk off, breakdown more likely than not. 171 is the level to watch. Apple is up first for our core list of companies. I'm showing you where this resistance is coming from at 162.75, but also something like a monthly inverted head and shoulders is very much so in play here, speaking to solid structure underneath us. If we look at the more relevant price action on the day-to-day over the past couple of weeks worth of trade, we have a balance area here which has broken in the upward direction, but just like almost everything else, we are dealing with an inverted hammer on today's session, so a flush underneath the lows here would be totally reasonable for a pullback, noting that we're coming off of a higher high. It's really not all that bearish just yet, and I would start to target the two very precise and equal lows at 154. You could think of it as a stop hunt, come down, then reverse off of it. It would just be very classic of the market to clean up and repair this structure because it's so precise, grab the stops, and then reverse. If we do start spending more time underneath 154 or even find a lower high underneath 156.50 on the reattempt out of the range, call a spade, we have a look above and fail, just like almost everything else. 147, the bottom end of the range, would be the target. 147.25 is the number there. Netflix, what's going on? Relative weakness here. We know that's the case. We have found a lower high, and H pattern is in play. Flush of 291 brings you to the lows at 280.50. If I go to an hourly time frame chart, I just want to remind you that the short squeeze from 2 Mondays ago, or I suppose it's last Monday, the short squeeze there doesn't really hold a candle, no pun intended, to the structure here at 291. So that is the number to be watching. 291 opens the door into 280.50. On any up moves, it's got to be a recapture of like a double bottom neckline here over this zone at 312 to 315.50. Next up is Tesla. This is a very interesting chart, definitely on watch tomorrow, considering that we have a range here. We have a look below and technically a failure into the range. Now it's all about finding higher lows on the daily chart above this zone. Over 188.50 is ideal. Technically some wiggle room back down to 185. Falling back down underneath, okay, kind of a fail from the buyers here, and we just get a daily lower high. We're looking for the equal lows and really a flush under 173. So primarily for tomorrow's session, it's all about what happens here on Tesla. I would love to see lows, higher lows, and a reversal back up into 200. Does the market ever give us exactly what we want? Not always, but one can hope. Next up is Google. What's going on? Very similar to Apple. Daily inverted hammer. A higher high was made in this overall sequence. We have lows, equal lows, highs, much higher highs again. Very reasonable for a pullback to unfold. The target first would be $100.50, and that's kind of your must-hold area in Google. Otherwise, it's kind of a nasty fall through thin structure here to backtest the neckline of the double bottom at 96.80. As of right now, considering the momentum, I would be kind of optimistic about a mild pullback and search for the higher low at $100.50. If it starts to break down, we'll take it as it comes to us, but as of right now, again, a little bit more optimistic considering the momentum in this overall stock. pullback reasonable, doesn't really damage the structure just yet. Obviously, the bears have something really going if we find a lower high underneath. Nothing about this chart would suggest that as of right now, at least. Next up is Meta. What's going on with Zuckerberg's fantasy land? This one's a little bit more concerning, noting that we did technically make a new higher high, but nothing about this is as structurally significant to what we just discussed in Google or even Apple, for example. So knowing that, it's all about consolidation here, building out a daily bull flag. That kind of keeps Meta bullish. And then we'll look for the break over 205.50. We know there's quite some range to move overhead. 221 is the target, but this doesn't really suggest anything meaningful, right? If you think about this as a range, we've closed right in the midpoint of that range. Maybe a breakdown under 195.50. You can start looking for shorts. Rebreak over the top is interesting for longs, but nothing about this is screaming, hey, trade me on tomorrow's session. Next up is NVIDIA. Big shooting star, big inverted hammer on today's session after making a significant higher high, testing prior structure as well. 274.25, totally reasonable for a pullback to unfold. Bulls want to see it ideally remain above 257. It's very, very optimistic. I don't think that's very likely, but a breakdown here isn't the end of the world. Structurally speaking, you can even retrace the thin structure on the breakout into 242, find a daily higher low, lows, higher lows, higher lows, higher lows, and we're good to go from a structural perspective. Of course, into the end of the week, it would imply some bearish pressure. So really watching the low of today's session, 262 and then 257. After that, there is some room to fall into 242. So maybe able to catch a pullback on the short side in NVDA. Next up is Softy. It did not make a new higher high on today's session, closed fairly weak. Watch for a flush of the two lows. I would really start to target the neckline, honestly, of the double bottom here at 260. So if a pullback does unfold, looking for 260. Anything that just kind of chops around in here is exactly that, choppy. Maybe it turns into a bull flag from this perspective, and we'll take it one step at a time eventually, looking for the gap to close overhead. But nasty inverted hammer. Again, this is not unreasonable on tomorrow or even into the end of the week, Friday session, 260 on the pullback, neckline of the double bottom. Next up, last but not least, the mini beast. We've got Amazon putting in a bull flag well above the top of its balance from in here, double bottom. Very similar to what was it, Meta, where it's kind of just putting in a sideways range here in the midpoint of the range. Maybe there's something to do at 96.50 on a pullback, daily 50 SMA. Wouldn't really be chasing new longs after looking above and failing on today's session, but it's really not bearish until we break down and find a lower high underneath 96.50. So taking this one in stride, 96.50 is the one level that I would carry forward on your charts. Last but certainly not least, I've got 3 additional trade ideas to share with you for all the night owls. Adobe is up first. ADBE is the ticker here. Bearish engulfer on today's session with a high above the prior high and a close underneath the prior low. Looking for a continuation into 350, which represents the neckline of this double bottom, for a break retest and then continuation back in the upward direction, searching for the higher low after the double bottom above the neckline, above the previous structure here. And we've also got the daily 50 and 200 SMA meeting us here for super support. So step 1, seeing a pullback. Step number 2, looking for the hammer candle, looking for the daily double bottom or intraday double bottom, daily intraday inverted head and shoulders, and then trading back in the upward direction over those necklines, over this high, into the pivot high, just north or right around the area of 375 on the upside. If it fails to hold here, obviously off the table as a bullish trade. Next up, UNH, United Healthcare. We know that the healthcare sector as a whole is a quote-unquote recessionary theme. If that's going to hold true, we want to see this turn into an inverted head and shoulders here for something that looks like this. A break of the neckline is recapturing 482, which is the daily 50 SMA where we rejected on today's session. So just like Adobe, step 1, pullback. Step 2, holding 470. Step 3, break the neckline. Easy target is back up here, close to the round number at 500, and also offered up prior rejection points in the past. Next up, we have FDX, which is the last trade idea I have for you. FedEx, just zooming it out, or actually leaving it zoomed out, I should say, to just note that we are in an overall uptrend. We've just found a higher high, looking for a pullback into the trend line. We're still going to produce a higher low. So the uptrend is strong, but we have gap structure underneath us to contend with. So if the market is going to fall apart into the remainder of the week, this is looking like a decent short underneath the lows here to travel through the gap range into the 50 SMA, into the prior high here at 205. Roughly the breakdown is under 216. That's all I've got for you on today's session of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a thumbs up. And I hope to see you in tomorrow's pre-market prep at 8:30. Have a green trading week.